and Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad Izzat Syafiq bin Masyahril and my partner is Amirul Ilyas bin Amri from JBA 2513D. In this video, we will explain the article review from the article The Role of Green Investment and Corporate Social Responsibility Investment on Sustainable Performance.
Before we move to the details, let's have a short introduction to ESG. The term ESG is an acronym for Environmental, Social and Governance, which refers to a set of standard behavior by a company on how they contribute to the society. ESG is considered as a form of investment which screens investments based on the policies made by the corporation to alleviate awareness of acting responsibly in its management. The key highlight of the article has pointed out three issues on ESG. The first one, the transition to the green economy is quite a challenging process due to changes in project financing and law enforcement. Secondly, the manufacturing companies in Indonesia contribute 20% of the environmental damage, which triggered companies to disclose the sustainable performance. Lastly, many existing research ignores how green investment and CSR investment can improve financial performance on a sustainable performance of a company.
Findings from the article. Firstly, this investment avoids companies' legitimacy gap or social and environmental conflicts. Second, increase the company's performance as it convinces investors to make sustainable investments. Third, perceived as consistent and responsible with an environmental ethic because it is believed to reduce carbon emissions as well as improve green energy and green technology. Fourth, green investment, which include low carbon and sustainable climate resilient, critical component of a company's sustainability that will inspire investors confident in their decision to make a sustainable investment. Fifth, improve company's financial performance as the cost of green investment disclosure is lower than the cost for companies that do not disclose their environmental performance. And last, improve company profitability, sustainable performance, image and reputation. Research method. The sampling method used by the study was purposive sampling. The method in managing the business effect on the environment, company or business will minimize energy use, reducing carbon emissions and other negative effects. Next, the method for green investment measurement is by using proper rating or company performance assessment in environmental management. The proper rating can be divided into 5 types of color, which are the gold color for the very good rating to the black color for very poor rating. Next, the method for financial performance measurement. The financial performance is measured by using the profitability ratio with the proxy of return on asset ROA. Lastly, the method for sustainable performance measurement, it will be measured by using the Sustainability Report Disclosure Index (SRDI). The SRDI indicates a score of 1 if the item is disclosed and a score of 0 if the item is not disclosed.
The study in the article has three variables. The first one is independent variables, which are from green investment and CSR investment. The second one is the intervening variable from the financial performance affected by both of the investments. Lastly, the dependent variable is driven by the sustainable performance data. Moving on to the article data, the table shows the descriptive statistic for the main variables. As we can see, the green and CSR investment variable has a high mean value, which means the cross-section data between companies does not have a fairly large range difference. The financial performance variable shows a low mean value, which means the cross-section data between companies has a fairly large range of differences. For example, in terms of return on assets, when there is a deficit in a company, there is also profit in other companies. Lastly, the sustainable performance data shows a high mean value affected by the green and CSR investment.
So, this investment has helped an organization boost its performance, decision making and growth. It also helped the investor to reduce risk by predicting their return, which will increase the percentage of their return on investment. Green investment will also benefit the economy, ecology and environment of a country as it increase employment and income contribute to economic activity, infrastructure and assets that can reduce carbon emissions pollution, improve energy, resource efficiency, and prevent loss of biodiversity and ecosystem services. So that's all from us. Thank you.